Welcome to Real Vision. I am Alfonso, the author of the Macro Compass, and I'm here today with David Rosenberg, who's the founder and president of Rosenberg Research. My pleasure to have you here, David. How are you doing?
I was going to say doing great, but here in Toronto, Canada, we're basically back under lockdown. Let's hope it's going to be temporary. Welcome to where I spend 24/7 under this situation, which is my home office. But it's wonderful to be on the call with you today.
Hey, thanks. And actually, I'm talking from the Netherlands here, where we pioneered the lockdown 2.0 in winter, and we are still in lockdown as well. So I can completely understand you. Not nice.
I share your pain. So, but I painted a smile on my face just for the show.
Fair enough. Let's try to make this call fun then and nice and with plenty of content, which is not going to be difficult given you are the guest. So let's probably get started from the main question out there. I mean, we have had inflation printing almost at 7% in the last print, 6.8% in CPI. Bond yields are trying to get a little bit higher. 10-year yields are maybe 1.7%, not even there. So a lot of people out there are asking me, us, and many more strategists, how the heck? How is this possible? And, can you please explain to us what's going on there?
Right. Well, this ongoing conundrum, as Ben Bernanke and Alan Greenspan have called it in the past, when there seems to be this disconnect between inflation and where Treasury yields are, over and beyond the fact that the Fed has been an active supporter, not just for Treasuries, but for mortgage backs. But you would have thought, I suppose, that with the Fed already starting the taper, already telegraphing that they will be done by March, and that they'll start hiking interest rates shortly thereafter. People think they might even start at that time. That alongside all the inflation and all the rampant growth expectations, that Treasury yields should be soaring to the moon. And if you go back through most of this year, the bond bears have been saying we're going to 2%, 2 to 3%. And you're right in the sense that we're, back at the high end, getting towards the high end of the range on the 10-year note. We haven't broken above it, but we're still well below where we were before the pandemic broke in early 2020. All I can really tell you is that, when people say, well, how can we have inflation? As you say, inflation is going to get to 7%. How, with the temerity, the nerve of the 10-year Treasury note yield being at 1.7%. But it's not inflation that drives market interest rates. It's inflation expectations. And that's really anybody's guess. Where is inflation going to be 3, 5, 10 years down the road? Firstly, inflation is a lagging indicator. Everybody has been so consumed with the lagging of the lagging indicator, along with the unemployment rate. The most lagging economic indicator is the inflation rate. It tells you nothing about the future. Inflation peaked at almost 6%, if you remember, back in the summer of 2008, and we had the wonderful commodity super cycle. Everybody thought that Bear Stearns was in the rearview mirror, and the housing crisis in the rearview mirror, and that the Chinese double-digit growth commodity super cycle was going to take us into a future of everlasting inflation. I was at Merrill Lynch at the time. I remember debating my good friend, still good friend, Rich Bernstein, who was chief strategist at the time. I was chief economist. We debated constantly, internally and externally, over inflation. Now, who knew? Who knew a year after inflation touching 6% in the summer of 2008 that it would be negative year on year the following 12 months? So it's about inflation expectations. And I'll tell you that the one thing that really I find fascinating, and I think maybe the most important inflation expectation indicator, is the 2 to 5 year inflation expectation component out of the University of Michigan Consumer Sentiment Index. Remember, this survey goes back 5 or 6 decades. And this is inflation expectations by the people that do the shopping. It's a 70% of the economy called the consumer. So these are not dictated by bond traders. These are not break-even levels. This is what Household America is telling you about their view on inflation beyond this year, understanding what the term transitory really means. I never understood why the Fed gave up on transitory. Maybe they just should have defined it, because to me, in the overall realm of economic and financial history, 1 to 2 years, to me, is still pretty transitory, or maybe we need another word for it. But you see, the household sector is telling you that beyond this year, with the supply bottlenecks and the commodity pressures that we've seen, that their 2 to 5 year view is inflation to average 2.4%, which actually is the low end of the range of the past several years and below where it was when the pandemic started. And so something's happening here that's very interesting. We all bellyache about inflation, but then again, it's staring us in the face. But the bond market doesn't move on what is staring us in the face for the here and now. It's really looking out many years. And you got to believe that if the Fed starts to pull the rug on liquidity, and understanding that this has been a liquidity bull market in residential real estate, in cap rates, in corporate credit, and in the equity market, what is going to happen when interest rates start to go up? And the key here, again, is the shape of the yield curve is half as steep as it normally is at this stage of the cycle before the Fed starts hiking rates. So we might not be beyond 3 or 4 rate hikes before we start talking about recession pressures. That's going to undercut asset values. And then there'll be a knock-on effect on aggregate demand. And that is going to create a future of disinflation or deflation. So you see what the bond market is saying, and this is a long-winded way of saying this. The bond market is looking at the forest past the trees, as everybody else in our business just looks at the trees.
I mean, this is so great. So let's try to unpack it a bit for the audience, because you presented so many facts and actually important things. So let's start from the fact that bond yields are forward-looking rather than backward-looking. So when I used to manage a fixed income portfolio and a multi-asset portfolio, fixed income was a large portion of that. Trading bonds was always trading expectations of inflation and real interest rates. That's basically the combination that proxies together with let's say term premium, proxies nominal yields as a sum of the three, right? And just described that inflation expectation and the University of Michigan survey 2 to 5 years ahead are a, unremarkable 2.4%, if I can say. It's more or less in the range, actually the low side of the range of the survey. But also if I take market-based inflation expectation and I look at 5-year forward, 5-year CPI, it's a very often looked at measure of market implied inflation expectations. I'm looking at CPI being priced at about 2.5%, but the Fed target is on PCE, which normally has a wedge slightly lower, 20 to 30 basis points, historically lower than CPI. So even both the consumers and fixed income investors or whoever hedges inflation via the market is telling you, we expect inflation to be around slightly above 2%. That's it. Actually, that's what we're looking at. When we look at the real rate component, that's another part we get asked a lot. Those real interest rates are extremely low. And, they are ranging about minus 1%. The front end of the curve is even lower. 10-year is about minus 1%. Might it be that real interest rates actually is the part that drives long-term interest rates up, or is that not foreseeable, and why?
Well, I think that the powers, the fundamental forces that have driven the natural rate of interest, or R star, as you would have put it, haven't gone away. And those are principally aging demographics in the industrialized world, tremendous growth in technology as a ongoing economic disruptor, and of course the massive indebtedness. These are the fundamental forces that have triggered the ongoing decline in real interest rates. So I just tell people, look, there's lots of things that we can argue are not going back to what we consider to be normal before COVID. That much is true. But what COVID didn't change is the aging profile of the populations in the developed world, point number one. And of course, we're seeing the aging population in China as well. These tend to lead to lower real interest rates. I'd say that did COVID alter the debt profile? Yes, the debt profile, which is an absolute crushing blow. It's a major constraint to aggregate demand. And the debt ratios across the world only got bigger because of the COVID. This is going to be a fundamental future constraint on demand. It's the massive run-up in debt that has caused Joe Manchin, for example, a Democrat, to say enough is enough on the debt side. That's a critical constraint on real aggregate demand. And that's another critical reason why real interest rates not only will stay low, I would argue actually that they'll go even lower. The reason why most people are bearish on bonds isn't about the real interest rate. It's really about their view on inflation and inflation expectations. And we've had a major disruption this past year. There's no doubt about it. We did have an inflationary shock. Only a fool would tell you. I mean, you'd have to be blind not to see that we had a massive inflationary shock. But what I don't understand is why people have trouble explaining why this is in fact transitory. And it hasn't really led into inflation expectations. People talk about a unionization drive at Starbucks. Okay, I mean, really big deal. Strikes at Kellogg and John Deere. Again, big deal. This is a $23 trillion economy that's really ridden on the back of the small business sector. Not mega businesses that make cereal or expensive coffee. And so we had, and when you look at the inflation data, we weren't talking about inflation this time last year. It really started to accelerate in March and April. And what happened was that we had the Delta, and the Delta seriously impeded global supply chains in a major way. We had a massive supply shock. The supply curve turned increasingly inelastic in economic terms. And then we had Joe Biden pass a massive fiscal stimulus plan. So we had this tremendous growth in demand bumping against the inelastic supply curve. Well, Economics 101 will tell you that for a while, you're going to get big inflation. But is it going to last? I mean, the fiscal stimulus isn't lasting. These were stimulus checks and they're done. We're going into a future of fiscal restraint. Fiscal stimulus is going to take, the withdrawal of fiscal stimulus next year is going to drag at least 3 percentage points out of GDP growth for next year. And then we're going to get the monetary drag on top of that. Then we can talk about Fed policy. That had more an impact on asset inflation. But we had massive fiscal stimulus boosting aggregate demand for a period of just a couple of quarters. It's over. And then we had the supply chain issue, and it created 6 months of massive inflation. Absolutely. It reminds me a lot of what we saw coming out of World War II, where again, we had the troops come home and created tremendous aggregate demand, but the rations came off more slowly, and the supply side had more difficulty adjusting. And we had 2 years in the United States of double-digit inflation. Inflation actually hit 12% shortly after World War II. And yet bond yields actually just stayed in the range. I don't know what it was about the bond trader back then wasn't going ballistic over inflation, because I think back then maybe they understood that transitory could be 1 or 2 years. And in fact, it was. So my sense is that when we're talking about the Treasury market, and we're talking about 2 to 2.5% inflation expectations, what I'm telling you, and this is what get derisions of laughter, but frankly, I don't care. I've done the homework. I've got my view. I think inflation is going to be a lot lower. I'm talking about Japanification. I think inflation in the next 3, 5, 10 years is going to be a lot lower than 2 to 2.5%.
So David, what you're saying basically is, look, guys, there are two things here. There are structural factors that are impacting both the inflation and the real growth, and actually they're pushing both of them down. And those are, those structural forces. It's very difficult to fight. We're talking about aging demographics. We're talking about impending technology. We're talking about unproductive debt loads, I would add, in the private sector, not only in the public sector. Those are impediments, of course, to aggregate demand. This is the structural trend where we're going. It actually has worsened with COVID because you already explained why. And then there are cyclical swings like the one we have had. Nobody's here to say we didn't have inflation. We had supply bottlenecks. We had aggregate demand picking up. So the combination of the two caused a cyclical upswing, right? And then, of course, if you look at the 40s, the comparison is there. Bond yields were much lower than inflation rates, also because the Federal Reserve entertained in yield curve control sort of exercises. But nevertheless, we had a similar situation where aggregate demand was very strong and supply bottlenecks were there. This is all very similar to what it was in the past. So there is nothing different to expect here. If I would ask you, what would make your mind change from a structural perspective? You have a core thesis, it's very clear. What facts would have to change to make you change your mind?
Look, if in fact we start to see this inflation feed into inflation expectations, if in fact the bright lights out there are right, that we have this great retirement theme, people are going to be able to live on the 401ks, never go back to work. If people are right that we've hit the labor supply wall, we just hit the supply wall on labor, we're going to have an explosion of wages. If that happens, my call will be wrong. If for whatever reason people start to shift their views that this inflation is going to be persistent, it's going to lead into inflation expectations. Of course, that then leads into wages. Then we are into a wage price spiral. And I'm not going to say that's not going to happen, because you can't rule anything out in this business. That's the one thing I've learned after 35 years is that, you don't put all your eggs in one basket, and there is no such thing as a sure thing, but you still have to have a base case scenario. And then you have to have a plan B, because without a plan B, you don't have a plan. But that said, I think the risk to my view on interest rates will come down to within the next 12 months. Does this feed into sustainable wage growth? Have we hit the wall on labor? I got to see more evidence. It's way too early to make an assertion. Even this great retirement theme, it's pretty fresh. And in fact, what's interesting is that the participation rate peaked in 2000 when the first of the baby boomers started turning 55.
Yeah.
And it went down for 20 straight years. And through all the ebbs and flows, did inflation go up or down over that period? Well, it went down and was actually pretty stable. Very loose correlation between the participation rate and the inflation rate. But, people like to fit the narrative to the action in the prices. And so they fit this particular great retirement theme. It's very evident to me that the participation rate has lagged because of the COVID, simply put. That continues to have distorting impacts. So we don't even know really, what does the world look like? We're all making assertions. I mean, there's a wide uncertainty interval here, because we're all making assertions of what life is going to be like post-COVID, assuming that we can ultimately morph from a pandemic to an endemic. And I think we have to believe that that's going to happen, and probably will happen this year. But we're not there yet. So everything right now is guesswork and assertions and narratives. And I'm saying give it time. Where I'll be wrong is if, in fact, we've hit the wall on labor. If, in fact, we're at full employment, in which case we're going to get much more dramatic wage growth. And at the same time, inflation expectations. If I see evidence that they're going to become unglued, I'll be forced to change my call. I haven't seen that yet. But those are really the risks to my forecast. What I'm trying to say here is that people are underestimating, as you said, the secular, powerful disinflationary forces that have not gone away because of COVID, and that the debt overhang is massive and a huge constraint. Once again, look, we had tremendous stimulus in the last cycle, 2009, 2019. We had tremendous monetary and fiscal stimulus. And it still ended up being the weakest economic cycle of all time. We averaged real growth barely better than 2%. It was the worst economic cycle of all time. Of course, the stock market was on wheels because of all the policy stimulus, and companies, instead of investing in the capital stock, bought back their stock. And that gave earnings per share, you could say, an artificial lift, but you had earnings growth, not just from the E, but also from the share count going down. And on top of that, we couldn't even get the funds rate past 2.5% in the last cycle. And that tells you the power of the debt as a massive constraint on economic growth and on interest rates. And I'm looking at the debt to income ratios for the overall economy in the major industrialized world, and principally in the United States. And it is a huge disinflationary force. I can't believe people don't talk about if you're taking a longer term view, if you take, the stock market is a long duration animal, but the bond market's a long duration animal. And so we had a 1 year inflation bump. Go back to the period leading up to the big commodity cycle that peaked with oil, not at $80 a barrel, but $150 a barrel, that everybody thought was going to go even higher back in the summer of 2008. Big danger at inflection points, big danger to extrapolate what's staring you in the face into the future. And yet that's what I find everybody doing. We're going into this tightening cycle. The Fed is going to raise rates. They're telling you they want to raise rates. Neil Kashkari, who's the biggest of, is telling you he wants to raise rates next year. They're going to raise rates right after they finish the taper. Then it's going to be a question of, do they actually start reducing the balance sheet? But that's a different matter. They're going to start to raise rates into a fairly flat yield curve at a time when fiscal stimulus turns into fiscal drag. And you have all these asset classes so dramatically overvalued because of the policy setting that we've had in the past 3 years. We have to understand that we've averaged, the stock market has gone up 20% per year in the past 3 years. What do they all share in common? 2019, huge year for the stock market. Why? The Fed cut rates 3 times. Then we had another huge year in 2020, even with the pandemic and the brief recession, because the Fed cut rates 150 basis points and expanded its balance sheet by 80%. And then we had the extended rally. What were we up last year? 28% in the stock market. And the Fed didn't cut rates because they were basically at the zero bound, but they expanded the balance sheet by 20%, which is almost like they cut rates 200 basis points. You don't see what I'm saying here is that the stock market's up 60% in 3 years, and all 3 years had Fed easing. The Fed had the tailwind as an investor. But what happens when that becomes a headwind at these valuations? We have a CAPE multiple pressing against 40. We only saw that once in the past century, and that was in 1999. Price to sales over 3 times. That's even higher than it was during the dot-com bubble. We have price to tangible book over 15. And you take a look at the credit market. 300 basis points on high yield spreads. We've only been there 10% of the time in the past. Cap rates in real estate at 2%. We have nutty, crazy, massive bubbles everywhere. In fact, I would say that in my professional lifetime, and probably going back further, I don't remember there being so many asset bubbles taking place at the same time. But it's the equity market that's really important here. And this is what I'm really worried about. And this is why I'm not bearish at all on interest rates. Because what I'm scared, and what people aren't talking about, is what is the level of the panic going to be among the retail investor who has plowed all their money into these passive ETFs, these passive indices that are dominated by just 5 stocks. We haven't seen market concentration like this. Last 2 times the market was this concentrated was in 1969 and in 1999. And the year after, those 2 years wasn't such a pretty picture. But you see, the stakes are so high. People don't know the data. You go in the Fed flow of funds numbers, you're going to see that the level, that the amount of equities on household balance sheets is $43 trillion. It's twice as big as the whole US economy. You go back a decade, the level of equities on household balance sheets was barely more than 12 trillion. You see what I'm saying? It's 43 trillion right now. Almost 40% of the asset base for the household sector is in equities. Historically, that ratio of equities to overall household asset mix is 14%. Now it's 40. So what happens in the next bear market? And the reality is that we're going to have a bear market. Who can time it? I'd say the odds are high we're going to see one sooner rather than later, because I can see that policy is going to be shifting to a tighter stance, both fiscal and monetary, at a time of these nosebleed valuations. Trying to pick the time, hard to do. Will it happen this year? I wouldn't be surprised. Our starting point is 170. Well, let me just ask the question. You're telling me that we're no matter how people might think we got to 170 in the 10-year note, we're at 170. We're at 170 after an economic boom this year that was premised on massive fiscal stimulus, and let's call it the economic reopening. A lot of that is in the rearview mirror. We've come off 3 years average 20% increase in the S&P 500. Normally, the stock market goes up in price 7% per year. We have tripled what is normal 3 years in a row, and it's caused people's brains to get all fuzzy. And the greed is egregious, but we've seen this movie before. Now, the Fed is going to be raising rates into what is already a fairly flat yield curve. At a time of these egregious valuations, your starting point on the 10-year note is 170. Let's say that technically we break towards 2%. Everybody seems to want it to go to 2. Let's say that happens. Great. I'm gonna back up the truck and buy them, because this is where we are at the peak of the cycle. This is where we are at the peak of the valuation cycle in risk assets. This is where we are. Excuse me. We're at 170 on the 10-year note at a time when high yield spreads are 310 basis points. Seriously? We've only been there 10% of the time in the past, and equity valuations. So what I'm saying is that, can you imagine where the 10-year note or the long bond is going to go once things mean revert? And valuations, Bob Farrell's rule number 1, valuations, ratios, multiples, they mean revert. And we're peak valuations in risk assets. So I actually think that might be what some people in the bond market are seeing. Fed's going to raise rates 80% of the time. When the Fed embarks on a tightening cycle, 4 to 5, we land in recession. But the stakes are so high because the market, by some measures, price to sales, price to tangible book, never been this expensive. The Cape multiple only one other time in 99. Where are bond yields going to be going in the next few years? What do you think happens to household balance sheets, savings rates, consumer confidence, and spending if the stock market ends up correcting? And remember, when you're taking a look, what is $43 trillion on household balance sheets? You see, the thing is that households never rebalanced. They never rebalanced. They just kept on performance chasing. Do you know that for all the talk about the bond market, and the Fed has bought the bond market, or maybe Japanese financial institutions bought the bond market, the share of bonds on household balance sheets is 3%.
Yeah.
It's never been this low. Households, so you see, they've never rebalanced. They have never rebalanced their portfolio. They are up to their eyeballs on equity exposure at the peak of the cycle, with the Fed about to raise rates. So I'm telling you, will we go back to the lows on the 10-year no yield, which was about, what were they, 0.5%? That I don't know. But are Treasury yields a year from now likely to be lower or higher? Now, near term, they might go higher. Technically, as you said before, they're not trading very well to start out the year. But I believe that the stakes are high. Household balance sheets never having rebalanced, which they should have, because it's not about chasing returns, which is what people did. It's really about risk management. People don't understand that, because this past few years has been all about throwing caution to the wind.
Yeah.
And I'll tell you, that is what the Treasury market may be telling you that nobody talks about, except maybe for me and you.
So, David, on the Macro Compass newsletter that I write, I posted a chart that I think it's very easy to sort of basically use to picture what you're saying. The amount of leverage that is in the system, both private and public system, and the amount of risk taking out there is pretty large, but it's by design of the system to make, leverage more accessible. And if you indeed plot total debt to GDP in America, private and public sector, and you plot that against interest rates, you invert debt to GDP. So as basically debt to GDP goes down, it means it's going up because it's inverted. You will see 30-year real interest rates or nominal interest rates, it doesn't really matter, go down as well. So the game seems to be that as we take more leverage upfront, we basically borrow from future consumption. That's what we do, right? We take credit on, we try to make this credit more accessible for people, having interest rates as low as possible. Balance sheets become levered in the private sector. People have a risk-taking mentality. They do it, they live this wealth illusion effect, basically, where thanks to lower discounting rates and more accessible credit and more leverage and higher valuations, it all feels fantastic, right? So now you plotted out in your last piece that you think this time the Fed can raise rate maximum 4 times. And again, we are starting from 0%. We're going all the way up to 1%. The bond market at the moment, if I look at forward rates and I calculate them, is telling me that the terminal rate is at about 1.5%. David Rosenberg is telling you guys approximately it's around about 1%, where you think some cracks can start to unfold already in this highly levered system.
That's right.
Can you tell us why is it 1% this time? I mean, in 2018, they managed somehow to get all the way up to 2.5% in Fed funds rate. This time you think it's 1% only. The bond market is pessimistic. You're even more strongly opinionated on this. Why is that?
Right. Okay. Well, the one thing I'm going to say, back up something you just said, which is that the Fed did get to 2.5% very temporarily. And I was saying in the last cycle, they would have trouble getting much above 2%. And they got to 2.5%, and then everything fell apart. Yeah. We went almost 2 months without a high yield bond issue. Credit spreads ballooned, and the stock market in short order went down almost 20%. Some of the cyclical stocks went down 30-40%. Then next thing you have, the Powell pivot.
Yeah.
So no, it's not where they tried. They tried to get, he wanted to get to 3. 3 was the Fed's nominal equilibrium rate. He said, we want to get to 3. And in fact, if you go to Powell, just in October of 2018 was talking about, we might not have to just get to neutral, which they said was 3. We're going to have to get past neutral. That was a direct quote.
And actually, David, I remember trading that market, and Powell back then used to say that they were actually far from neutral. They were on autopilot, and they were raising this long-term dot plot. It was already 3%, and they were raising it from time to time. And this time, it's at 2.5%, and it's not been moving from there.
Well, look, I think that firstly, the most important thing is that the Fed had believed that the neutral funds rate in nominal terms back in the last cycle was 3%, as you said, 3% plus. First thing that Powell did when he got appointed as Fed chairman and then confirmed was the Fed raised their estimate for the neutral funds rate. Dead wrong, and they've already done their mea culpa on that. They went to 2.5%, you're right, in December 2018. But the bigger story is where we finished off the cycle, because it was a gross admission of a policy mistake that they would have cut rates 3 times in 2019. I mean, coming off an epic Trump tax cut, that they realized that they had blown it. And remember what the yield curve looked like heading into the pandemic. Things were cooling off in the economy even before we got struck with the COVID-19. The key is we finished off the last cycle at 1.75 on the funds rate, in that steady state of 3.5% unemployment, full employment, if you want to call it that, and 2% inflation, which is where we were. What I'm saying is basically, has the population gotten older? Yes. And has the debt gotten more onerous? Yes. These are the driving forces why the neutral rate continues to go down. So based on our estimates, and especially what we did when we ran our models was we said, let's say they take the funds rate up 100 basis points. What is that going to do to debt servicing capacity and the impact that's going to have on aggregate demand? And secondarily, what is the impact going to be on the wealth effect on spending in terms of what it means for asset values? So we did both. We did the impact on the markets back to the wealth effect on spending, modeled that through. And we wanted to figure out, first and foremost, what is the funds rate, not necessarily that will create a recession, but a growth recession. What's the funds rate that will take growth below potential and cause unemployment rate to go back up? So that was really how we got to the 1.25%. That's the most they'll be able to do. And you're quite right. That the bond market has got right now more priced in. It's not a lot. I mean, a lot of people are always saying to me that the bond market's only got 1.5 to 1.75 peak funds rate. You got to be kidding me. Well, of course, because they're only looking at the latest inflation numbers. But my peak funds rate's even lower than that, and that's one of the anchors for why I'm bullish on Treasuries.
And about your asset allocation, right? We discussed about the macro view, but people, of course, have an investment horizon in front of them. Let's say 6 to 9 months from now, given this investment horizon, how would you tilt? What would you be overweight? What would you be underweight in an asset allocation portfolio?
Look, I think that I think people will be surprised at how low inflation is going to be in the coming year. I know it's out of consensus. It's a very controversial view. And I say that knowing that the rental component of the CPI is going to be problematic for the next several months. People don't see, though, that when you're taking a look at building permits, units under construction, starts, completions in the multifamily space, it's booming. Supply of rentals are coming back in a major way. Now, you have to understand here that we never had a boom in rental demand. Rental demand since the pandemic started has been growing at roughly a 1.3% annual rate. What happened was that just as the farmers culled their herds because of the pandemic, apartment developers were told by the experts, nobody will ever want to live in a high rise again. So there was a time period 8 months ago where multifamily housing completions were down 40%. Well, so of course the vacancy rate plunges, rental rates surge, but why anybody thinks that's going to be permanent? Do people think that a high rise or even a low rise will never get built again? But you see multiple family units under construction are at a 47-year high. We're going to have a deluge of supply of multifamily in the second half of next year. Vacancy rates are going to go up. Rental rates are going to go down. We've modeled this out. And it's important because 40% of the core CPI is OER and rents, as I'm sure as you well know. The commodity complex is at a high level, but inflation is about rates of change, not levels. The commodity complex, it seems to me, even oil, looks like it's forming a peak. The base metals are forming a peak. There's lots of other commodities related to greening of the world that you might want to buy that are in a bull market, but most commodity prices have already hit their highs, and that's going to have an impact with a lag. On the 40% of the CPI, that's goods, that's products. So I think inflation is going to be melting in the second half of next year. And we've done a lot of work on this. And the fact that it's a non-consensus view, that's fine with me. That means it's going to be a nice surprise for people that have high quality, long duration bonds. So I'm very bullish on 30-year treasuries. In fact, I'd be saying buy 30-year zeros. People say to me that that's crazy. Who wants to buy treasuries at these low levels of yield? And when people tell me that, and I try not to be disrespectful, it just says to me, you just do not understand why you own treasuries in this environment. And it's not because of yield. And it's not because you're going to make a killing in the bond market. Although maybe total return-wise, because of the price, you will, if the Fed slips up and growth slows precipitously next year, and I'm right on inflation. Treasuries are a diversifier. They are inversely correlated with the equity market. They are one of the best insurance policies you could have. They are a ballast. But the thing about treasuries is that they have unusual, unique characteristics that no other asset class on the planet has, which is the certainty of payment. Bitcoin does not give you certainty of payment. Neither does gold, despite its safe characteristics, supposedly. Equities certainly don't give you a guarantee of payment. The 10-year treasury note is the only thing on the planet that you know with certainty where you're going to get paid 10 years down the road. There is no default risk. There might be other risks. There's no default risk. There's no call risk. There's no prepayment risk. And it is about diversification, which people have not done, sadly enough. And I think we're going to see a big rebalancing towards treasuries this year as a result. I mean, it has to happen because the gap between bond returns and equity returns last year was 30 percentage points. I think the stock market was up 27, 28%. The 10-year note was a negative return of 4%. That's over a 30 percentage point gap. So there's going to be rebalancing into bonds. I'd like long-term treasuries. A lot of that, though, is really hedged, less maybe on fund flows and more in my inflation call in the second half of the year. Remember, my inflation, big disinflation is a second half of the year story, which means that if yields back up between now and, say, spring, you want to be adding treasuries at better valuation levels into the portfolio. Now, alongside that, I want to have an income stream out of the portfolio. You can't get yield out of bonds. You're not buying bonds for yield. Again, you're buying them for safety valve and diversification. If the stock market goes down 20 or 30%, you're going to want to have bonds as a hedge. It will mitigate the damage. Just think of what happened when the stock market went down 30 some odd percent during the pandemic. You really had hoped that you had bonds. When the stock market went down 20% in the fourth quarter of 2018, you wished you had bonds. So for that reason, especially at these eye-popping, really almost record levels of valuation equities, where do you go from here? Bonds will be a diversifier and will mitigate the downside risk to your portfolio. So I like long duration, high quality bonds. On top of that, in the equity market, that's where you can get yield. So what do I see out there that's attractive? I like utilities. I like pipelines. Telecom had a rough year, but they're paying a 5% dividend yield. So utilities, pipelines, and I also would say that industrial REITs, a good place to be. Self-storage is in a secular bull market. Again, nice cash payouts in those particular REITs. And even the gold mining stocks, I think are very attractive. Dividend growth of 70%, and so that's something else I'd be looking at. Canadian gold miners, I'd be looking at pipelines, utilities, telecom, industrial REITs. And I'd be saying for global equity investors, if you're long only equity and you can invest globally and you believe in Bob Farrell's rule number 1 on mean reversion, and you're taking a look at the historical multiple discount that emerging markets are trading against developed world, I'd be taking profits in the US and I would be applying them in the emerging market world. I also believe that if you and I are both right on the fact that there's too much Fed priced in, the US dollar is going to be going down, not up. And that's going to be a feather in the cap for emerging markets too. They tend to do better when the dollar is weak. Dollar right now is really topping out. That's an added benefit for the emerging markets. And I would say that the top market that we're looking at right now, we just wrote a report on India. And even though you can argue that Modi's reforms have been slow to take place, they have taken place. We've detected actually inflation is starting to break to the downside in India. We've detected that their non-inflationary GDP growth potential has been improving. When that happens, you want to buy the financial assets, whether it's through ETFs probably, or just by the Sensex. But both bonds and stocks look attractive in India right now. That's probably our top emerging market pick abroad. I would say something else. The US stands out as really the most expensive stock market in the world. So even if you want to, not delve into the risk of emerging markets, at a minimum, take profits in the US and move into Europe, where our work is showing that it's much more attractive coming into this year than the S&P 500 is.
Yeah, so this is the asset class allocation of David. Basically, in a nutshell, there will be long TLT or long-term treasuries. There will be short industrial commodities, so some selected high beta version of industrial commodities. If you have to be invested in the US stock market, it's rather the low beta names and the high beta names. So we're talking utilities, telecoms, and these kind of names. You can have a peek at some emerging markets where you can find value long-term, like India. And well, what else do you want to know? Thanks, David, for this very, very full of content and good interview. You can find David work where, if people want to find you?
Well, just email me directly, drosenberg@rosenbergresearch.com, or simply pick up the phone and give me a call, 647-802-4146.
Quite an accessible Canadian guy. If you want to find my work, it's at the Macro Compass on Substack. It's a free macro newsletter. Thanks, David, again for the interview. And I hope I'll have you back sometime in the next quarters to cross-check our views.
Great. I'll take care. Happy New Year.
Thanks. You too.
Hey there, revolutionaries. To join a community sharing professional insights like what you just watched, head over to realvision.com and get unbiased insights and exclusive access to the very best, brightest, and biggest names in finance. Join our community of lifelong learners.